Economic issues are at the top of voters' concerns for this year's presidential election. Many people with investment portfolios are asking the question, who is better for the stock market, Biden or Trump? In this video, I look at the key tax and economic provisions of each candidate in the context of the equation for expected stock market returns. Full disclosure, I worked as a foreign policy analyst for Joe Biden years ago. On the other hand, I grew up in DuPage County, Illinois, which at that time was about the most Republican voting county in the nation. I'll do my best to present a balanced perspective. I am using the fundamental market return formula in assessing the candidate's policies. The return of the stock market is determined by three key inputs. 1, corporate earnings, E. 2, dividends paid by corporations, Y. And 3, the change in the price-earnings ratio. The E plus Y in the equation reflect what companies actually earn and return to shareholders in the form of dividends. The PE reflects how confident investors feel about the economy and the growth of corporate earnings. The more confident people feel, the more likely they are to bid up the prices of stocks relative to their earnings and therefore a higher PE ratio. Former Vice President Joe Biden would enact a number of policies that would raise taxes and new revenue of $3.4 trillion over the next decade. This includes $1.4 trillion from higher corporate taxes, $990 billion from higher payroll taxes, and $944 billion from increased individual income taxes. Under Biden's plan, the corporate tax rate would increase from 21% to 28%. Large corporations would be required to pay a minimum tax of 15%. Biden is also proposing tax breaks for certain businesses. These include favored industries such as clean energy and manufacturers that renovate and modernize their facilities. He also supports a 10% Made in America tax credit for companies that invest in the U.S. Under Biden's plan, income taxes on individuals who earn more than $400,000 a year would rise from 37% to 39.6%. There would also be a 12.4% Social Security payroll tax for wages above $400,000. Additional tax measures include limiting itemized deductions and phasing out the qualified business income deduction for those with taxable income above $400,000. Biden also proposes to tax long-term capital gains and qualified dividends that are above $1 million at the ordinary income rate of 39.6%. He also proposes ending the step-up in basis on investments with capital gains. Lastly, Biden's plan proposes lowering the federal estate tax exemption from $11.58 million to around $5 million. The Tax Foundation estimates that over the long run, Biden's tax plan would reduce GDP by about 1.5% and reduce after-tax incomes by around 2.6% across all income groups, with the top 1% of taxpayers facing an 8.9% decrease, the next highest 5% of earners seeing a 1.9% decrease, and everyone else having about a 1.4% decrease. Biden's proposals, therefore, mostly affect the very wealthy. Biden's proposed $5.4 trillion in new spending includes $2 trillion on infrastructure, $1.9 trillion on education, $650 billion on housing, and $530 billion on health care and entitlements. This spending should have a significant multiplier effect on economic growth. The $5.4 trillion in spending, less $3.4 trillion in tax increases, results in deficit spending of around $2 trillion. President Trump has not issued a concrete plan beyond desire to make the Tax Cuts and Jobs Act permanent. Trump has already signed an executive order deferring the collection of Social Security payroll taxes and has said he would push for the deferred taxes to be forgiven. He may also try to implement additional payroll tax cuts. Trump potentially may lower the current 22% tax rate for individuals to 15% or otherwise adjust tax brackets to put more middle-income people into lower brackets. Trump is also expected to seek permanent status for at least some of the provisions in the Tax Cuts and Jobs Act that lowered taxes for individuals. Right now, most of those tax cuts are set to expire after 2025. Trump would likely want to extend provisions, including those that lower tax rates, increase the standard deduction, double the child tax credit, and establish the tax credit for other dependents. Trump has also said that he wants a second round of stimulus checks. In addition, Trump has suggested reducing the top rate on long-term capital gains from 20% to 15%. He has also called for indexing capital gains for inflation. Trump's second-term agenda list also calls for expanding opportunity zones, but details have not yet been provided. Other tax-related items Trump has advocated include Made in America tax credits for companies that bring back jobs from China, 100% expensing of deductions for essential industries like pharmaceuticals and robotics, restoring the deductibility of meals and entertainment costs, and extending business tax breaks in the Tax Cuts and Jobs Act. One significant economic factor is how President Trump would approach tariffs in the second term. In his first term, Trump imposed more than $80 billion of tax increases in the form of tariffs. Recently, the president has said he would impose tariffs on companies that do not move jobs back to the United States from overseas. Whether this is a formal policy proposal is unclear, but it indicates the possibility of continued tariffs if Trump wins re-election. The lack of detail in Trump's plan makes economic impact assessment difficult. The Tax Foundation estimates that if the president extends the Tax Cuts and Jobs Act and nothing else, the after-tax income for individuals would increase an average of 1.5%. The top quintile of earners would see the highest average gain at 2.4%. According to the Tax Foundation, Trump's plan would also increase the deficit through 2028 by more than $600 billion. Former Vice President Joe Biden's plan would increase tax revenue by $3.4 trillion over the next 10 years. As noted, about half the revenue comes from higher taxes on corporations and half from higher income taxes. For corporate taxes, the burden would likely fall both on corporate earnings and labor in the form of reduced wages. For individual taxes, the burden would fall mostly on the wealthiest 1%. The net result of these taxes would be modestly reduced U.S. economic growth and corporate earnings. The E, earnings and Y, dividends in our market valuation equation would be reduced a bit, which would likely be a moderate negative for stock prices. However, Biden's $5.4 trillion in new spending, of which $2 trillion is deficit spending, would be a boost for the economy. This spending would offset some of the negative impact on corporate earnings of the tax policies, particularly for those industries benefiting from increased spending on infrastructure, housing, healthcare, and clean energy. Trump's plan would more or less maintain the status quo and perhaps moderately boost long-term economic growth by keeping in place the current tax cuts and the additional deficit spending. This would be a moderate positive for the stock market. So the E and Y part of the equation, Trump's plan is moderately favorable for the stock market and Biden's moderately negative, mostly due to the higher corporate and payroll taxes and their effect on corporate earnings. With regard to the PE part of the market equation, if people feel that a Biden presidency is more a return to normal in government and society, they may feel more optimistic about the long-term stability of the U.S. economy. This greater confidence could be reflected in a higher PE ratio for stocks, which would be a positive for the stock market. If Trump is reelected and faces ongoing attacks from a Democrat-controlled Congress, this could contribute to uncertainty and have a moderately negative effect on the PE ratio and stock prices. So, with regard to one candidate's policies being better or worse for the stock market, it's likely a toss-up. The trade-off is potentially higher growth under Trump, but more uncertainty around people's feelings about the country and society overall. Higher taxes and lower growth under Biden, but a potential relief rally, as people feel that there will be more of a return to normal in society due to a conventional politician and Democrat assuming the presidency. Of course, all of this depends on the makeup of Congress. If Biden is elected and Republicans retain control of the Senate, any legislation that is passed will likely be muted forms of the Democrat proposals, therefore having even less effect on the economy, corporate earnings, and the stock market. On the other hand, if Democrats take both houses of Congress and more extreme policies are pushed forward, this could increase uncertainty among investors and therefore have a greater negative effect on the stock market. Lastly, of note, both Biden and Trump's plans call for large deficit spending. In addition, the Federal Reserve has indicated it will be keeping interest rates low and will allow inflation to run above its long-term target of 2%. If unexpected inflation occurs and inflation shoots significantly above 2%, there could be significant stock market volatility. Thank you for watching.